Good morning, everyone. Thank you for attending this webinar, which is basically ICRA has arranged with the collaboration of TIOB, and the topic is understanding of loan and syndication for African markets and for international markets as well. The agenda of this meeting is that Mr. Patrick will give the opening speech to the audience. Then I will take some minutes and brief about ICRA, what ICRA is and what we are doing and where we have our presence. And then our main speaker, Mr. Aditya, is an AVP in Loan and Syndication Bank of Africa DIFC branch and taking care of international operations and loan syndications for Bank of Africa as a whole group out of the IFC. He will be our main speaker and he will share his experiences and brief on loan and syndications. What are these? How the market works? What kind of loans, type of loans? And then after that, we have a question and answer session. And then at the end, our director, Mr. Hassan Mansour, who is taking care of Africa Whole Operations, he will give the final remarks. Over to you, Mr. Patrick, sir.
Thank you very much, Zishan. So good morning from Tanzania, and I've heard some people saying good afternoon to each other. So good morning, good afternoon, and if possible, good evening. You're welcome to this webinar, the first of many, arranged with ICRA and TIOB in partnership. My name is Patrick Mususa. I'm the Executive Director of the Tanzania Institute of Bankers, TIOB. Just part of my opening remarks is to highlight the journey so far, why we've arranged this webinar. ICRA is a credit rating agency that is taken up the model of trying to make access to financing avenues for the African market more accessible. And in Tanzania, we were fortunate enough to begin dialogue with ICRA as they were setting up. And we are lucky enough to have started the year very well with the initial event engaging the industry together. From a TIOB perspective, we are an institute that is very much continental as much as it is global. We are part of the Alliance of African Institutes of Bankers that spans across the continent of Africa. But also we are part of the Global Banking Education Standards Board, which is domiciled in Europe and has a global perspective, a global outlook. We have been part of the coordination of World Conference of Bankers Institutes across the world, the last one being in Malaysia, Kuala Lumpur, and the next one being anticipated to be in Scotland. So the journey in terms of banking education is a journey full of partnerships, very effective partnerships, strategic partnerships that look at bringing real solutions to an industry that is trying to solve challenges, making access to finance possible. And one of the things that we've actually experienced in our market in Tanzania as an institute is that banks are looking for affordable funding for their lending activities, always looking for affordable funding for their lending activities. In some cases, you find that this funding that is available to them locally is not exactly affordable or cheap. It's expensive. And therefore, there's still the top line pressure of actually reducing the cost of credit to the consumer. That is becoming the increasingly larger agenda as we are going forward in the new administration in Tanzania, where we have a new economic outlook with new sectoral development strategies in different sectors. The financial sector has a master plan of its own in Tanzania that is keen to implement. TIOB is pushing to play a role in that in terms of our market experience, and we see ICRA as a formidable partner to be able to address some of this. Now, the topic at hand today, loan syndications, is something that I am grateful to ICRA for bringing on board Mr. Aditya Alamuri. I will let Zishan introduce him. For me, I was keen for them to highlight the benefits of actually gaining an understanding around loan syndications and what a credit rating agency, what role it plays in that, in the sense of making these facilities accessible to banks and financial institutions in a local market that are trying to access affordable funds that they can then able to channel to the right avenues in order to be able to better serve their customers and clients. At TIOB, apart from these partnerships that we run, we also have our certification programs that help prepare professionals for the Tanzanian market and perhaps even beyond as we adopt curriculums from various more global leanings and localize them to make them accessible to professionals who are trying to build their banking career. So for me, I would like to take a moment to thank you all who have joined us on the webinar today. We've been pushing this as much as possible on our social media platforms and in social network groups and WhatsApp. We thank you for responding to the call. And we hope that this will be as valuable to you as you are valuable to us in terms of your giving us your attention. With that, I would like to end there and hand over back to you, Zishan.
Thank you so much, Mr. Patrick, for these kind words. Thank you so much for always, collaborated in each and everywhere where we are going. We had a wonderful event back in January with all the bankers in Dar es Salaam. And this is, as you said, that this is one of the many webinars and many more to come. They are lined up as we discussed. What ICRA is now, I'll just brief it out very quickly, then I will hand over to Mr. Aditya. ICRA, how ICRA formed, how ICRA comes into the picture. ICRA have felt that there is a huge gap in between, the big fours, their services, credit rating services to the African continent and many other countries around the globe. That is because of might be that the entities based in these countries are not the target clients for them, or the entities or these markets or countries, they are not able to reach out to them for the credit services. So ICRA felt that one, and then ICRA has been formed, and our focus market is definitely for Africa, subcontinent, GCC markets, because these are the markets which are very well connected with each other, and definitely we cannot avoid European market. The European market, the financial sectors are the one who are quite interested in African markets and providing their financial assistance and support all the time to these countries. When we formed ICRA, so we know that, that we are doing in different jurisdictions. So in our team, it's a very experienced team. Our chairman and the senior team, they have over 25 years of experience in this field. We have 10 different nationalities in ICRA who are from very world financial institutions around the globe, international institutions. Moreover, some of them are from the big three rating agencies as well. So that's how we have combined our expertise and providing our services in these areas. This is our global presence. I would say that, Tanzania, UAE is our head office, and we are over managing all our operations, global operations from here, because UAE is one of the global hub right now. You can say that all the major financial institutions, almost everyone, insurance companies, investors, finance houses, they are having offices in UAE and very easy to communicate. Tanzania is the first one where we got our accreditation from Bank of Tanzania. So we are accredited by the regulator in Tanzania, the banking sector. The second country was Uganda, where we get the letter from the Bank of Uganda. Very recently, we got our Security and Exchange Commission license in Pakistan. Zimbabwe and Zambia we are on the verge of getting our license from the regulators, and we have rep offices in Spain and United Kingdom. As I said, that Europe is also one of the biggest partner of Africa and the rest of the country to provide financial services. Very quickly, I will just brief out that, okay, what are our services, what we are providing, and which can be utilized in any kind of a services, just like loan and syndication as well. Issuers rating, and simple word, each and every entity which comes in a supply chain are eligible for the credit rating, subject they are maintaining at least 3 years of audited financials. Portfolio rating services, we offer these services to banks, to insurance companies, and big conglomerates who have a wide range of client portfolio. Investor services, we call it our customized services that the banks, investment firms, or insurance companies, they can utilize our services for that one. ESG is also we have included because ESG is now playing a pivotal role in the system, and most of the factors are connected with the financial sustainability, funding. And I'm sure that Mr. Aditya will cover very well covered in this topic as well. We are also having a scorecard for the initial assessment for the SMEs and individuals. Banks can quickly, within 5 minutes, you can assess any individual that they are eligible as per your requirements or not. And the companies, it takes 15 to 20 minutes. Then you can assess them initially and take the decision that those are potential customers for the bank or not. So these are our expertise, and these are the services globally available for any country. Now I will request Mr. Aditya. He was my ex-colleague as well in my previous organization. We work together. I know him. He is a good gentleman with good education background, a good experience in African market as well. Mr. Aditya, I will be happy if you brief them about yourself. I will hand over to you, sir.
Isang table dyan, Eric. Isang table. Doon tayo mag-start. Huwag na upuan. Kukunin ko yung nasa hallway.
I think Ms. Erla, can you please switch off your mic? Yes, Mr. Aditya.
Thank you, Zishan, for the introduction. At the outset, I would like to thank Ikra for arranging this, and of course, Tanzania Institute of Bankers for arranging this and spreading word about this on their social media platform. Special thanks to Mr. Patrick and for the great words of introduction there. In fact, he's touched upon the main reason why we are here today. When we say understanding loan syndications, the reason we want to understand loan syndications is because it is one of the ways to enhance your treasury efficiencies. And when we say that, what we are essentially saying is that the bank treasuries or the corporate treasuries, or whatever access to funding they have, syndications is a way to not only access the market, but also slowly drive down the cost of your funding and thereby pass it on to your customers as well, and then basically reduce the cost of your credit and pass it on to your customers, which will actually drive kickstart and drive the economy forward. Now, particularly for Tanzania, I mean, going ahead in this presentation, not only would we look at the loan syndications market as such, but I would also like to dedicate some time to some of the case studies wherein syndication loans were launched. And we will keep it as specific to Tanzania and Africa as possible, so that it is the benefits are understood clearly, and then the participants or the audience will also feel more at home to a case study which they would actually connect. Can I have the next slide, please, Zishan? I've structured the presentation in this way, where we'll initially discuss about syndicated loans, then we will look at the types of syndication, then we will look at the documentation aspect of syndication, and then how they are generally structured and processed. The presentation itself is kept at a bare minimum. I mean, they're just pictorial cues. There'll be more of a talk rather than the pictures here. So I will be, that's why the question and an answer session also, I would like to keep quite a bit of time for that, because I would want the participants to get back to me with any of the questions that they might have. Next slide, Zishan, please. So I'll touch upon briefly upon where the syndicated loans have actually origin. To give you a brief perspective, there are two main types of fundraising activities. One is through loans, the other is through the bonds. You would all are aware that there is a bond market and there's a loan market. Typically, these two are either supplementary or complementary. Generally, if the bond market is doing very well, the loan market slows down. But if the bond market isn't doing that well, then the loan market picks up pace. But otherwise as well, there are a lot of I mean, there's a difference between some of the key corporates who are looking at a bond market specifically for raising funds, and there are some corporates or sovereigns who look at specifically the loan market to raise funds. There are certain advantages of both. And here we are to discuss why the loan market is advantageous, what are the benefits. We will also look at some of the cons as well to have a balanced perspective of the syndicated loans market. Now, this was originally, this began as a solution to allow lenders to lend larger amounts of money to a single borrower. Now, not only is it an aspect of credit appetite, but as we have had Basel norms come in, wherein a single obligor limit had to be set, prudential limits had to be set by the central bankers in each of these countries. So smaller banks, they found it very difficult to actually lend to good corporates because the requirement of the corporates is so high that the smaller banks would always, in essence, exceed their single obligor limit or prudential limits. So that is where, out of this need, where there are big corporates requiring large amounts of funds, that is where the need actually began. In fact, it's not even corporates. We've had governments borrowing for their treasury activities, and that's where now to fund a government, for FIs to fund a government, it would be obviously difficult because not only will each of the FIs have specific country limits with them, they will also have obligor and or borrower limits. So that, and obviously if they have to also have trade finance activities within that limit, it will be difficult for them to exhaust their entire limit in this. That's where, out of this necessity, the syndicated loans were actually born. Now, the first syndicated loan was recorded to have been executed in 1968 in the London market. And through 1970s, it was developed mainly for sovereigns. So that's where the sovereign borrowing began. But at the turn of the century, the range of these borrowers has moved from purely being to sovereign to investment grade entities like corporates. And these are big, large corporates. And then slowly, as the secondary market developed on the syndicated loans, I'll about what is a primary market and what is a secondary market. So slowly, as the secondary market started evolving, you've had more lower rated borrowers, not only investment grade corporates, but also sub-investment grade FIs, corporates, and sovereigns, also tapping into this syndicated loan market for raising funds. Now, previously, it was typically managed between banks, wherein pure banking license FIs only used to participate in this. Slowly, with the advent of DFIs, and then we also had asset management companies come in. We've had large insurance firms come in, where they tap a lot of funds. Then you have public finance institutions coming in, like pension funds. So slowly and surely, over the last 21st century, once the secondary market for active trading of syndicated loans developed, that's when we've had all the other agencies also come in. Like, it's not restricted anymore to pure FIs. It's developed, it's spread to a lot of other financial institutions and non-banking financial institutions as well. So now we've had a lot of non-banking participants come in, and that's where the syndicated loans market has been able to tap into a huge source of funds, not only restricted to the banks. To give you a perspective of where the syndication loans market is right now, in 2022, we've had in excess of $1,400 billion raised in the syndication market by various entities. Now, this market over the last 6-7 years has been growing at 14.2% CAGR and is expected to touch in excess of $3,700 billion by 2030. And Africa's share in this is at a very minuscule 5%, which obviously, considering that Africa is the next destination of growth, where there is growth, where there are returns as well, if risk is mitigated properly. we should actually hope that Africa gets to at least 20% of this market. Most of the market is being controlled, continues to be controlled in London, although there have been alternate markets developed for Asia in hubs like Singapore and Hong Kong, where it's driven mainly through the Chinese banks, which form the top five, top six banks of the world. But essentially, it's always been regulated and controlled through the London market. And even the insurance facilities that come in to these syndicated facilities, they have also, that's the reason why a Lloyd's market also has been a factor. The presence of huge insurance market there in London has been the reason why syndicated loans have also typically come out of London. We've now had different sectors where we call the one which Africa falls under is called the EMEA syndicated loans market, which is basically emerging markets, Europe and Africa. Now these are so African laws have typically, what the good thing about Africa is that their central bank laws as well as their general law is very much I wouldn't say it's a good thing, but it's because we've all been, India as well as Africa, we've all been colonies of Europeans before. So our legal framework has been typically inspired by what has been there in the UK and in the Europe. So it's these laws are very much close to the English law, and that is the reason why our entire framework, the legal framework of Africa, is very much in alignment with the English law. And typically syndicated loans being controlled through the London market or through DIFC market here in Dubai, where I sit, and even African loans that are borrowed, overall it's managed under English law. Can we go to the next slide, Zishan? Now, before I go ahead with detailing of how the market works, I would like to discuss a few important terms and decisions. I'll take a few moments here. Now we are looking at, first is arranger or a coordinator. Now this is a lending or a non-lending entity that is appointed to act through the grant of a mandate by the borrower. So basically, if, say for example, borrower A wants to raise money in the market, now it cannot go by itself and raise money. It cannot be an agent to itself. So it provides a mandate to another arranger or coordinator. Now, even if, say for example, a Standard Chartered Bank or an HSBC bank wants to raise money for itself, to act for a, because the arranger or the coordinator has to be neutral and has to be a representative of both the lending as well as the borrowing entity, they cannot appoint their own selves as an agent. So what they basically give a mandate to a different entity. This entity can be a lending entity or a non-lending entity. So it's typically over here we've had capital markets divisions of banks or even the banks themselves being appointed as an arranger or a coordinator. Now, these get appointed through a grant of a mandate. Now, what is a mandate? The mandate is the document signed between the borrower and the arranger or book runner for the arranger's services, primarily being advising the borrower as to what type of facilities it requires and then negotiating the terms of these facilities. Now, this arranger is paid a fee for this task. Now, this arranger, if he's a lending entity himself and if the arranger is participating himself or herself, in the market, then this fee is separate. It's called the arranger's fee. And the fee that is paid to the borrower itself is called the participation fee. So basically, if there is a lender coming in and the borrower is paying a fee to all the lenders coming in into the syndication, that's participation fee. But the arrangement fee is paid purely to the arranger. Then we have I've touched upon a term called book runner in the previous definition. Now the book runner is basically appointed by the borrower to put together a syndicate of banks to provide the facilities and to ensure that there are clear market conditions. Now the arranger can also be the book runner. Sometimes the arranger is different, the book runner is different, because sometimes they would prefer specialist people for them to advise on the terms and conditions of the facility that they want to launch. So the arranger may be a capital market service, but a book runner may be a proper bank, which has got the expertise of actually having contacts and relationships with various distribution and loan treasuries of other banks, wherein they can actually source funds. Now, again, what is clear market conditions? Now, when a syndication deal is launched, what we need to ensure is that there is no other parallel primary syndication being launched at the same time, because under syndication, one of the advantages that I'll discuss later is that the pricing is predetermined. The pricing is predetermined by people, by this arranger and the book runner going out into the market, doing a pre-sounding exercise. They'll go out into the market. They won't reveal the name of the actual borrower, but then they'll say that, say, for example, if government of Tanzania is borrowing, they'll say that a B-rated East African country is in the market looking for funds. Say, for example, the deal size is expected to be about $500 million. It is for a specific project or for their own treasury boosting activities. And we will go and say, what is your appetite? Do you have an appetite? And we will say that what is the interest rate at which you can come at? And then this feedback is given by the arranger and the book runner to the issuer, which is the borrower. And then they will arrive at a number which they are comfortable at. And this, so for the issuer, which is the borrower, so now which is MOF Tanzania, for example, the government of Tanzania is borrowing. So yeah, I think it's better for me to give it on an example basis. So let us all assume that the borrower is government of Tanzania, so that we can discuss everything, all terms going forward. So government of Tanzania has appointed an arranger, say Standard Chartered Bank, and a book runner, say Bank of Africa. Now, government of Tanzania will ask Standard Chartered Bank that they want to borrow for about 3 years. So please go out into the market and tell us at what rate we can raise these funds. Now, what Standard Chartered Bank will do is they in conjunction with the book runner, which is Bank of Africa, both of us will go to the market. We'll go to our respective relationships. We'll ask how much can you take on government of Tanzania, and we'll arrive at a number. And we'll arrive at an average interest rate. We'll go back to the government of Tanzania and say that, see, this is the interest rate over so far that we are able to get you. This is the margin that we are able to get you. We've had interest that has come in from a number of borrowers for this particular tenor. Say, for example, 2 years, or some of them can go up to 3 years and some of them can go up to 5 years. Then we will ask government of Tanzania as to what is the project that they are looking at. So government of Tanzania will say, for example, that this is what this particular social project that we're looking at, like an infrastructure project, like laying roads or railways, and they will look at what they will look at their own treasury cash flows, balances. Now, there are other aspects that government of Tanzania would need to look at because they are signatories to the IMF. IMF and the World Bank will be lending to them. So there are specific debts that they need to adhere to. So they'll look at all those debt ceilings. They'll see how much cash flows they have, which are basically tax inflows for the government of Tanzania. And they will say that we are okay and comfortable at this price and at this tenor, say 6 or 7 years. So we will go back to the market again, the book runner and the arranger. We'll go over to the market and say the government of Tanzania needs 7 years. So tell us what is the pricing you would require, and then we'll arrive at a final pricing. And that's how the terms are decided. So between the launch of a syndication deal and the closure of a syndication deal, which happens approximately anywhere between 1 month to 3 months, there's a lot of background work that needs to get done. And all this background work is done by the arranger and the book runner. And they do it through the mandate document that has been signed. Now, when all this exercise is being done, if there is a parallel exercise being done, if some other book runner or an arranger goes into the market and says that we are also looking for government of Tanzania as a borrower, this is the project. So if that happens, then there is a confusion, and the lenders would also think that probably this borrower is desperate and they're desperate for funds, so we can jack up our prices. So that's the reason why we always have clear market conditions, wherein if one syndication deal has been mandated and it is in the running, then a parallel syndication deal on the same borrower name should not run, so that there is a proper and efficient price discovery that can happen. Now we look at what is a primary market. I've touched upon this before, what is a primary market and what is a secondary market. Now, to be very clear in terms of processes, when you sign the facility agreement, the loan agreement, when it is signed after all the processes are done and the borrowers come in, as part of the facility agreement, as a signatory to the facility agreement, that means they are participating it in the primary market. Their seller is either the arranger or the coordinator or the book runner from who they're actually interacting with and actually participating in the deal. So any participation that happens before the facility agreement is signed and the borrower and the lender himself is a signatory to the facility agreement, that's primary market. Anything that happens after the facility agreement execution is either general syndication or secondary market, wherein a trading happens between all the people who have borrowed in first. Now, there are subdivisions to it. I'll get to it when we look at the type of deals that we do. So basically, secondary market are where secondary loans are traded by lenders. These lenders are either banks or investors with a pre-agreed date of transfer. And this asset is assigned by a new lender coming on record by the facility agent. Now, who is a facility agent? This is an agent who acts as the representative for the syndicate of lenders that is appointed by the borrower as well as the book runner to carry on the deal for its tenor. Now say, for example, a 7-year deal is launched by government of Tanzania. What government of Tanzania says is they will ask Bank of Africa and Standard Chartered Bank to come back and tell them who is the facility agent, who is going to run this deal for them. And then there are various facility agents. A lot of banks have their own agency services. You must have heard about agency services. A lot of banks have these agency services. So either a bank's agency service can be appointed, or there are standalone services who are actually running these agency services in London. So even appointment can go there. Typically, bank agency services are a bit more expensive than your standalone ones, but then the processes are more defined. Now, again, there is a commercial aspect to it. So some of the book runners or the arrangers, they would also look at agency services being assigned to them, so that's an additional income from this particular deal. So for that, they will probably agree to put in their own funds as a participant to this deal. So whenever a particular bank which has got its own agency services and can also act as an arranger and can also act as a lender, so when they lend money to this particular deal, so all these fees, the arrangement fee, the participation fee, and the agency fee that may accrue from this deal is the total income that they get out of it. So there are some commercial terms to this as well. So sometimes the facility agent is typically the agency appointed by of the bank, which is actually the arranger as well. So for example, Standard Chartered Bank has got its own agency. Mizuho Bank has got its own agency. So whenever they come in as arrangers, typical facility agents are appointed. But sometimes the borrower power is also more. They insist that the facility agent cannot be the same as the arranger. And that's where it's all divided. Like, for example, Standard Chartered can become the arranger, Bank of Africa becomes the book runner, and Mizuho becomes the facility agent. Can we go ahead, Sishan? Now we're looking at types of syndications here. There are 3 main types of syndications that are done. One is an underwritten deal. Second one is a club deal. And third one is best efforts syndication. Now, when we go to the case studies later, we will look at each case study for each of these 3 types of syndications. Now, what is an underwritten deal? This is where the arranger or the book runner guarantees the entire amount mandated by the borrower. It's either a part guarantee or a full guarantee. Now, essentially what happens over here is that the borrower, say government of Tanzania in our case, for example, insists that he needs the funds at a specific date for his activities. And there is no time for a general syndication for us to go to the market, gather these funds from a syndicate of lenders, and then actually send them to the borrower for his use. So either it can be because of time, or it can be because of a guaranteed return, wherein the borrower would say that I would need these funds at this specific time. So what the arranger or the book runner will do is that they will guarantee it. When the mandate letter is signed itself, it will be signed as an underwritten deal, wherein basically they commit a specific amount. Now, for example, government of Tanzania wants to do a road project. Now, what they would do is, for that road project, they've already arranged a EPC contractor. Now, when the EPC contractor needs to be paid for the road project to start, so what government of Tanzania would say is, Bank of Africa, please underwrite this deal and then you can syndicate it later. So what Bank of Africa will do is it will go to its own credit committee and say that we are going to underwrite this deal. And then the credit committee will ask Bank of Africa, its distribution team, that how much will you be able to syndicate? Then the distribution team comes back with their market sounding and they will say that if it's a $100 million deal, for example, let us underwrite $100 million. We are confident of distributing or syndicating $50 million out of it minimum. So the exposure on Bank of Africa will be 50 million. Now, if, for example, the book runner's distribution team comes back and says that we are yet to do the market sounding and we've not yet received feedback and we can probably only sell off about 20 million odd. And then what Bank of Africa will do is they'll go back to government of Tanzania and they'll say, look, as of now, we are not sure whether we are able to syndicate it or not. So we will partly underwrite it and partly syndicate it. So the guarantee is restricted to a specific amount. Now, this amount can either be because of market position or because of the arranger's own capacity to lend. Now, for example, Bank of Africa has a $150 million limit on government on Tanzania as a country itself. Now, we are not lenders only to government of Tanzania, right? We are also lenders to some major corporates in Tanzania as well. Now, whatever we lend to these borrowers, whether they are corporates or whether they are FIs, this all comes under this limit. So that is where we say that we can only probably partly underwrite this deal. Now, the pricing arrangement between the borrower and the arranger is obviously when if it's fully underwritten, the pricing is higher because the risk is higher. If it's partly underwritten, the price is lower. And if it's not underwritten at all, then we move to something called best effort syndication. So here the arranger or the book runner will not give any guarantee. Bank of Africa will say, I've done my sounding exercise. I am confident that I will be able to syndicate this deal for you. But then I'm not going to give you any guarantee. I'm not going to give you any underwritten deal. So whether Bank of Africa will participate or not is not a given there. And it generally an arranger participates in the deal unless it's a club deal. I'll get to where there is a club deal. So borrower will have to take whatever amount is mobilized by the arranger. Now in the mandate letter, what they will say is that for a deal to be called successful, there's a minimum amount that is prescribed, because for each of these deals, there is agency fees that the borrower needs to pay, legal fees that the borrower needs to pay, and the deal running itself. There are some platforms like Dead Domain where they take a fixed annual fee for running this deal. So there are fixed costs involved of running a deal. So that all forms part of the borrowing cost for the borrower. So government of Tanzania will say, okay, you are confident of mobilizing 100 million, I need 100 million. So let's launch a deal for 100 million. Do your best efforts. And if the best efforts indicate that it can actually go up to 150 million, we will be in a position to take 150 million. But for the deal to be successful, the minimum amount required is 50 million. Anything lower than 50 million, I am not in a position to incur any fixed costs on this particular deal. So the deal is termed as a failed deal. So that is where best effort syndication is the type of deal where people go for. And they will say that whatever is mobilized, there is an upper limit, there's a lower limit that is there. And typically whatever is mobilized by the arranger will be taken by the borrower. Now there is something called a club deal. Now here there is a specific group of lenders that they target. Now this can be based on geography, this can be based on lenders. Now here there is a bigger strategy involved. So for example, big supranational firms, what they do is they would want to diversify their sources of funding, because that's one of the reasons where their credit rating is also impacted. Now, for example, Ikra, when they come and do a rating for one of the banks in Tanzania. Now, if the bank in Tanzania, if their funding source is half deposits and the remaining is through the market, now again through the market, if they're borrowing only from the central bank or only from a specific bank, the rating will say that the sourcing of funds is not diversified enough. So there is a risk there, that there is a concentration risk there. So typically what all these banks do is who treasuries do is they try to diversify as much as possible so that they're not dependent on any one specific group of lenders or one specific geography. Sometimes the club deal is also because they want to target a specific group of lenders like DFIs. Developmental financial institutions come with a mandate, and their commercial profitability is not the only mandate that they have. Commercial profitability is one of the mandates that they have, but it's typically, say, for example, social impact, or there should be an ESG return on this. So these DFIs come in and they see that if there is a social impact for this particular project or for the particular deal, they're willing to lend at lower than market rates. Now that is where, say, for example, government of Tanzania, if it's building a hospital. Now this hospital that is being built, it's a super specialty hospital, for example, and there is a proper measurable social impact wherein people of Tanzania are going to be benefited. There will be third-party agencies who can be appointed to measure the social impact of how many people have got benefited over the years, and these will form part of all the parameters that government of Tanzania will tell their lender, saying that this is the social impact that this deal might have or probably in the future is projected to have. So people who have these mandates, social impact mandates, like DFIs, they will come in and they will say that, okay, if this is the social impact that is going to be there, I'm very happy to actually lend money at a lower rate. So that's where the lender type based club deal comes in. Now, in terms of geographical diversification, also there are deals. Now you must have heard about what is a samurai deal. Now Japanese deals altogether come back and say that we as a group of lenders, we have specific requirements on the information memorandum that we get on the deal. So because they have their own regulators to answer to. So what government of Tanzania does is it goes to a specific set of Japanese banks and they will tell the Japanese banks that we need money for a longer term. Now, Japanese banks and Chinese banks they are very, very liquid in the market and they can give you loans of up to 15 years. So they are the banks that you need to target for long-term projects that you have. Now, there are other short-term projects that you have where the liquidity and has to be very, liquidity is there, but then you need funds quickly. So now you have the European set of lenders where there's enough liquidity, and they have a specific set of requirements that for the use of funds. So if that matches, then you can go to the European set of lenders. Typically, you can go to an Indian set of lenders, or you can go to a US lenders. So it can be geography based as well. The club deal can be geography based as well. Typically, out of the entire syndication market, most of it is either underwritten or best effort syndication. Club deal is very rare, and syndication takes precedence for borrowers with good credit rating and who've been in the market before. Lenders already know the name and they've lent to that name before. And underwritten deals are typically opted to by where the time is short and where the credit rating is smaller and the market is very dynamic. We don't know how much is going to be mobilized. So that's where the underwritten deal is opted for. Next slide, please, Zishan. Now let's discuss some of the advantages and disadvantages. Now the first advantage, as we've discussed previously as well, is the access to larger loan amounts than what a single lender could offer. This could be because of regulatory restrictions that they might have in terms of prudential limits, or their own internal single obligor limits that they might have, their own country limits that they might have as their risk department would have specified. Now, the other advantage is potentially better interest rates due to increased competition among lenders. Now here, what is happening is good assets are very rare in the market. So when it gets syndicated, every lender knows that this is in the market and they know that the other lender who is their competitor is looking to take it. So there is a market demand that is created through the syndication loan. And once a syndication loan is launched and it is run successfully over its tenure of 3 years or 5 years, and the next syndication loan comes on the same name. Now everyone in the market, they know that this loan has already run and it's run well and payments have come on time and interest has been serviced on time. So next time what happens is it enables the issuer or the borrower to lower the interest rate, and banks will still come and participate and say that this is a good name, there's been no default previously, the deal has run well, the terms and conditions are good, the covenants that were specified in this particular loan, those covenants were complied with, and that is where the advantage of the syndicated loan is, where all the lenders in the deal, in the secondary market and the primary market, they know that this deal has run its course and it's run well, and they will come in and will be willing to participate in the next deal, and that is where the interest rates can come down. And in the case study, we will see to what extent the interest rates can actually come down when a successful syndication deal is run. Now, the other advantage that we have is access to a wider range of expertise and experience from multiple lenders. Now, lenders are various. Now, for example, if you're doing a road project, there are specific lenders who are extensively experts in infrastructure lending. Say you're doing an energy project, government of Tanzania wants to do a solar project. Now, there are a lot of Indian and Chinese lenders from where this particular material for this particular project is sourced. So these banks are already lenders to these suppliers. So these lenders will bring in their own expertise. They understand the project, they'll understand the cash flows, they'll bring in their own inputs to the financial model, and they will say that no, this is not going to work, this is a problem, this is the geography where you're going to source it from. So when you have all these set of lenders, Indian lenders, Chinese lenders, Japanese lenders, European lenders, US lenders, all coming in as a syndicate, you have access to this wide range of expertise from them. Now, what are the advantages for lenders? Now, we are banks, we are participating in the syndicated market. So what are the advantages for the bankers? It spreads the risk of default among multiple institutions. And I'm pretty sure, I mean, off the record, I don't, this session is being recorded, right, Zishan?
So yes, it is. Yes, it is. Yes, it is. It is being recorded.
Yeah, but even though it's being recorded, I would say off the record, I mean, it's all co-bankers here as participants. When you went to your credit committee, the typical question that is asked by a credit committee is which other bank is participating, right? Or which other lender is there? Who else has taken your risk? So it gives you a sense of comfort that your own competitor or your own co-lender or your own colleague in the other bank has actually said that, yes, I am going to take this risk. So you will have your own assessment, but then when 6 or 7 lenders or even more than 15 lenders say that we believe in this deal and we are happy to come in and lend over here, it gives you a sense of comfort. So it's basically spread of risk of default among other institutions. Now, this for the lenders, it also generates fees for arranging and managing the loan. Now, when you typically launch a deal, as I said, there is participation fees coming in. Now, this participation fees is paid upfront. Although when you calculate the return on this particular loan, you would all look at the interest rate as the main return aspect, but there's also participation fees that is given upfront. Now, that is a straight cash inflow for a lender. Now, if government of Tanzania is, for example, launching a 3-year deal and says that I will pay an interest rate of, say, for example, 3%, and they will also say that I will also pay a participation fees of 90 bips. So 90 basis points on your participation you can get as a fee upfront. Now, what will be the overall cost? Because this 90 bips has to, under IFRS 9, under IFRS regulations, you have to spread the entire fee over the tenor of the loan. So we would look at 3% plus 30 bips per year. So 330 is the margin. 330 basis points is the margin or is the all-in margin for you on this loan. But it's also a 90 bips upfront cash component. So that's one of the other advantages on a syndicated loan. The other thing is allows participation in large financing deals that you wouldn't be able to participate individually. Now, as a bank, as I said, we have single obligor limits. We will, even though we want to participate in that name, we cannot do it on a bilateral basis because we don't have the capability to fund their requirement. So this will allow, it's like a mutual fund, right? So all the syndicated deals come in, they lend together. There is a risk spread among it. There are other lenders also scrutinizing the performance of the deal going forward. So it's basically a kind of a comfort situation wherein you participate in a good name that you would otherwise not be able to participate in. Now, there are disadvantages to it as well. Now, the process can be very complex and time consuming. As I said before, people opt for underwritten deals, particularly when the time is short and they want the funds immediately, because the general syndication process is a long drawn process. Average time is typically between 3 to 6 months, because the pre-sounding aspect itself takes 1 to 2 months. The launch and the credit commitment process takes about 1 to 2 months. And then sometimes there are an accordion process as well, wherein the funds will come after the facility agreement is signed. So once the funds accrue to the borrower is not concerned about who is the lender on record at that point of time. Later, when it goes on secondary market, people trade the loans because the borrower has already got his funds and he's only going to service the interest or the principal as and when it is due as per the repayment schedule agreed. So there are lenders on record changing dynamically because we have a dynamic secondary market in the secondary loans. But otherwise, the process itself of raising funds can be complex and time consuming because there are multiple parties involved. You have an arranger, you have a book runner, you have multiple lenders having their own turnaround time to go to their credit committee and get back. It also involves extensive legal documentation. Now here, because you're getting lenders from across the world, all of them have their own legal requirements. Although this is done under English law, if say, for example, government of Tanzania is borrowing and tomorrow there is a, God forbid, there is a default. So at that point of time, if you have to opt for a legal remedy as a lender, you just cannot, although the document is under English law, you would also need to access legal remedies in Tanzania. So the legal documentation, not only is it done in English law, but the enforceability and the capability is also done as per Tanzanian law. So there are two legal jurisdictions where you need to get this done. Sometimes if it's not English law, if it's a local syndication, then of course it's right there. But sometimes you have two borrowers, one operating, say, for example, in Uganda, one operating in Tanzania, then you would need legal opinions coming in from both these jurisdictions. Some big corporates that are there, they operate across Africa and they want this money to be used across these subsidiaries in Africa. So you have 20 co-borrowers or co-obligors over here or guarantors over here. Then you would need enforceability opinion on each of these 20 jurisdictions. So it can get really complex sometimes, the documentation. So apart from that, the negotiation between the lender and the borrower can be lengthy and complex. Now at various stages, right? Now, for example, if we get a draft facility agreement and loan agreement and circulate it among the lenders, we have to take an arranger or a book runner has to take approval from these lenders. Now, these lenders, what they do, they refer this document to their own legal department. And each of them might have their own reservations, requirement of clarifications. So this to and fro negotiations only on the documentation can take up to about 3 or 4 weeks. And apart from that, the initial negotiation on the pricing itself can also be protracted. So these are some of the disadvantages that we have. Now, when we have a bilateral loan between one lender and borrower, it's a discussion between them, iron it out, get it done. But when it's a group of lenders with a borrower and then there is an arranger, there is a facility agent, the fees is discussed, the fees is negotiated. So the process can take quite long. Next slide, please, Ishan. So in terms of what documentation we have, we've already discussed what a mandate is. So there is basically initially a mandate letter. This is basically an agreement between the borrower and the arranger, which is an agreement to underwrite and arrange by best efforts. And then there are there's commitment amounts, exclusivity provisions, this clear market conditions, and all that is discussed in the mandate letter. The syndication terms and the costs of cover, and then there are several legal indemnity clauses that need to be there, that if there is a loss arising because of this process, then the arranger is indemnified. So all these kinds of clauses, standard clauses, they all come in this mandate letter. Then we have the term sheet. Now this term sheet is basically a basis for preparation of the facility agreement. Term sheet, when it is executed between the arranger and the borrower, is the basis on which legal firms actually start preparing the facility agreement. This is the term sheet that is also circulated first to all the lenders in the syndicate. when they're invited to participate in this deal. So this term sheet needs to be very specific, very short, very, brief, but also showing all the actual terms that do matter, like the facility amount and the type of facilities, what is the pricing, what is the terms of the loan, and what are the covenants that are being specified over here. So covenants are basically the conditions that the borrower needs to fulfill. Now, typically, for example, for say government of Tanzania, it might be that they have to fulfill the IMF restrictions on them in terms of borrowing. Their overall borrowing should not exceed so and so. Then there is a debt sustainability report that governments also publish now. So in that debt sustainability, there are levels of debt sustainability that is there. So that may be specified as a covenant that this percentage cannot be exceeded. For financial institutions, covenants are typically either net worth or capital adequacy ratio or tier 1 ratios that they need to maintain. So these are the covenants. For corporates, it can be different. I mean, if it's a trading entity, then we would specify a specific current ratio. If it's a term loan for a particular project, then we would specify specific DSCR ratios that need to be exceeded. Sometimes the covenant can have DSRA components wherein you want them to also deposit. You want to have an account, escrow account, wherein some of 3 or 4 months of repayment installments or interest has to be deposited in there on a regular basis. So these are the covenants. So these are basically the terms and conditions of the loan that are specified there. Now these covenants are monitored by the set of lenders. Now, who monitors it for them? The facility agent who acts on behalf of the lenders once the deal is done. He is the one who monitors. So we always get a covenant compliance certificate that is uploaded in the debt domain portal, which is, say, for example, if debt domain is the portal where the deal is being launched, then which has it is accessible by all the operating and loan department functionaries of the lenders. So it is the facility agent's responsibility to monitor these covenants on a periodical basis as decided in the term sheet. Now, if the term sheet says every 6 months we need to monitor these covenants, so these covenants are monitored by the facility agent and communicated in terms of a covenant compliance package to the lenders. If in any case there is a breach in the covenant, typically in the facility agreement, there is either a margin requirement or a time requirement by which the borrower has to come back to these covenants. So all these are also discussed in the loan agreement. Now, we also prepare an information memo. Now, this information memo is prepared by the arranger or the book runner and taken approval from the borrower, because there are certain confidentiality clauses and information that need to come from the borrower. So we prepare an information memorandum, and book runners prepare an information memorandum and circulate it to all the lenders. Now here there is an executive summary. What is the facility purpose? Commercial description of the borrower's business, their financials over the last 3 years, their latest management accounts if the financial closure has happened financial year closure has happened about 6 months before, the latest management accounts, and also the financial model of the project loan itself, how the cash is actually projected to come in and how this cash is going to service the interest obligations and the principal obligations. If it's a bullet repayment, then only interest obligations over the year and how they will be able to fund the final bullet repayment. If it's a proper amortized repayment facility, then periodical principal repayments has to happen. So all that is included in the financial model. Now, loan agreement is prepared by the legal counsels appointed. Now, on this loan opinion, the legal loan agreement, it is the duty of the legal counsel to also give a legal opinion on behalf of the lenders. Then there are fee letters. Now there are several fee letters. One is a fee letter that is exchanged between the book runner and the lender as to how much participation fee would they want to part with. Then there is an arranger's fee letter, which is exchanged between the borrower and the arranger. Then if it's a secured loan, then we appoint a security agent as well. If it's an ESG loan, we would need monitoring of these ESG parameter performance. So there is an ESG agent that is appointed. There's a third-party certification agent that is appointed for monitoring these ESG covenants. So then there is a fee that needs to be paid to them as well. So that also goes ahead, and they would need to all these form part of the fee letters that are there. Then we have the conditions precedent. Now this is basically the pre-disbursement conditions, as we call it. Now this is basically one of the main conditions precedent is execution of facility agreement and receipt of legal opinion from the agent. And apart from that, the KYC and AML requirements that need to be satisfied. Obviously, all the lenders would need to onboard the borrower. Similarly, the facility agent himself, being a financial institution or a party or an entity, regulated entity, they also need to onboard all the lenders. So all these form the conditions precedent. Next slide, Zishan. Then we have the structure and processes where I've also already discussed what is an underwritten deal, or what is a club deal, or what is a best effort syndication. So basically the process is this, wherein if it's not underwritten, first there is a mandate from the borrower to the arranger. They execute the term sheet, they execute the mandate letter. Then the arranger or the book runner prepares an invitation, sends it all to the lenders. Then once the invitation is sent out, wherein the specific agreement between them as to how much they will participate, there are slabs. Say for example, if there's a $100 million deal launched, and we will say that minimum participation is 5 million. So there are slabs that are decided. Say if the lender is going to come in with 10 million, we will give you a fees of 30 bips. If the lender is going to come in with 5 million, we will give you a fees of 20 bips. So there are slabs that are agreed. All that goes in the invitation. Then there is an information memorandum that we've already discussed that is circulated. Then as the syndication progresses, the arranger or the book runner will instruct the legal counsel to draft a loan agreement. Now this loan agreement is circulated in advance to all the participating banks or all the lenders that have been invited. They can come in with their comments. And then finally, on a specific day, which we say is the commitment day, all the lenders will have to commit before that day that they will be able to participate with so and so amount. Once that is decided, the loan agreement is finalized after all the inputs and changes that are required from various lenders. Now this loan agreement is executed by the borrower, by the facility agent, by the book runner, and by all the lenders. These are all signatories to the loan agreement. Fee letters, as is mandated between the borrower or the arranger, or between the lender and the arranger, and the conditions precedent fulfillment is given by the legal counsel. This is the process where it is not underwritten. Now, if it's an underwritten deal, so the mandate will come, and in which it is specified that it's going to be underwritten. Term sheet and mandate letter will come. The signing will happen first. As soon as the credit committee of the book runner or the arranger who's underwriting it, as soon as that clearance comes in, the loan agreement is signed only by the arrangers. Fee letters are exchanged and conditions precedents are fulfilled. So basically, if the signing happens before the syndication, after the syndication, it's not an underwritten deal. If it's an underwritten deal, the signing happens before it. After this underwriting happens, it's open for general syndication, wherein either the book runner will sell it in the secondary market, or will also again re-syndicate it between all the others. Now, if the general syndication happens and a new borrower is coming in and participating, he's still deemed to be participating in the primary market. But if the general syndication is not done and the book runner decides to sell it by himself and is not opening it out to a syndication and he's only it out to his various contacts, that becomes a secondary market. This is the main structure, and two different structures and processes for a not underwritten deal or an underwritten deal. So even if it's a club deal or a best efforts deal, the basic structure of the process is the same. Now, before this mandate of borrower to arranger comes, there is pre-sounding that is done. There are road shows that are done. If it's a new borrower in the market, people go out into various geographies. There are road shows done in London, road shows done in Dubai, where everyone is invited. And then the terms and then the commercial aspects of the borrower is discussed. And then a typical term, tentative terms of the deal are discussed. And all this happens before the mandate is signed. So basically, roadshows and loans and pre-sounding is basically an exercise to arrive at the terms between the borrower and the arranger. Next slide, please, Ishan. Right. So that is the conceptual aspect of it. Now, I'll discuss case studies on these three. As I said, we will keep it to Tanzania and Africa as much as possible. Now, let us go to a typical underwritten deal. Now, this is a live deal that I've had the chance to participate in as well. Some of the terms are obviously these. Basically, whatever is being shown over here, there are a lot of confidentiality clauses that we sign when participating in a deal. So these are the terms and conditions that are available in public domain. Some of the other clauses I would not be able to discuss because of confidentiality clauses. So in an underwritten deal, for example, now let's take the example of project SGR. This is basically the standard gauge railway project that Tanzania is undertaking. Now, this is a $1.19 billion deal being run under 7 phases. Now, government of Tanzania has opted for the syndication process over here, loan syndication process, to fund this project. Now, this project is a long drawn out project. It began in 2020 and is expected to finish only by 2032. And it's phased out because, for example, the first phase, it's called phase 1 and 2, is basically phase 1 is 300 kilometers of track, standard gauge track laying between Dar es Salaam and to Morogoro. And the second phase, which is called lot 2, is 422 kilometers of track laying between Morogoro to Mokotopura. I hope I'm getting it right. I mean, most of the audience are from Tanzania. So Dar es Salaam to Morogoro and Morogoro to Mokotopura, 2 phases, totaling about 722 kilometers. So this is the first phase of syndication that was launched for 2 phases of the project. Now, this total deal was $1.19 billion deal, out of which only 270 million is a commercial deal. The rest of it is pre-funded by the equipment manufacturing company. Now, to give you a typical background on this deal, now the EPC contractor is Yapı Merkezi from Turkey. Now, Yapı Merkezi, apart from laying the track itself, the mandate also involves developing of railway stations, developing of loop lines, developing of signaling equipment, electrification of the railway lines. So it's a huge project that is there. Now, this particular phase was launched for 722 kilometers and is expected to be operational in about 4 years. So this was launched in 2020, and the loan itself is valid up to 7 years. So 2020 to 2026, 26 is the repayment, final repayment of this particular loan. So this I'm discussing a specific part of that loan. The total is 1.2 billion almost, and out of which 270 million is a commercial deal. Now, I will not get into the specifics of what an ECA deal is or what a commercial tranche is. So whenever there is a loan that is being, a project loan that is being approved, typically to reduce the cost, what happens is, for example, here, if the electric loco and the track equipment and the electrical equipment is being imported, say from Switzerland. So Switzerland export agencies, what they do over there is, because there is an export happening from their country, they will be in a position, they'll be happy to fund it at a lower cost. So out of this 1.2 billion, 270 million is set separate as a commercial deal. The remaining 1 billion, which is basically taking care of the project component of importing equipment, is funded by a export credit agency. Now, export credit agency, because they are funding it at a lower level, what is the advantage for the borrower is it reduces cost for them. The commercial aspect of it, basically executing the project, laying down the lines, the actual physical contract work, that is what is allotted to the EPC contractor, right? So this EPC contractor, Yapı Merkezi, his deal size is 270. So that is being funded by an underwriter bank. In this case, it was Standard Chartered Bank. So Standard Chartered Bank has underwritten all the 3 loans that have been launched, 2 loans that have been launched so far. One is for lot 1 and 2, and one is for lot 3 and 4. The lot 3 and 4 primary syndication happened just recently in 2023. The lot 1 and 2 first syndication happened in 2020. So this is basically a general syndication, and Bank of Africa participated in this asset by purchasing it in the secondary market from the underwriter bank, which is Standard Chartered Bank. So Bank of Africa is a secondary participant lender. Standard Chartered Bank is the underwriter for this project. So basically, this facility is an ECA-linked commercial term loan. So 6 semi-annual repayments after moratorium. So total tenor of 7 years. So there was a repayment moratorium of 3.5 years. This, they have structured it in such a way that the track is laid and all commercial operations actually begin, and money is actually generated out of the project for the government. And so that money can also contribute to the cash flows of the government, which they'll be able to use to repay these 6 semi-annual installments over the next 3.5 years. The repayment has actually begun already in January 2024 and is expected to end by 2026. Now, this is how an underwritten deal works. Standard Chartered Bank has already lent money to government of Tanzania here, and later sold it down to other lenders like Bank of Africa. Now we look at what a best effort syndication deal is. Now this is one of the latest deal that has been done by Africa Finance Corporation. It is a supranational entity rated A. So they've got good pull in the market, and their deals previously have done well in the market. So they have been able to drive down the pricing to much less. Now this best effort syndication, they appointed multiple coordinators geography wise. Now they were looking to raise funds mainly from the Middle East, Europe, as well as from China. So what they've done, so first Abu Dhabi Bank, Mashreq Bank became the coordinators for Middle East and North Africa. MUFG, Standard Chartered Bank, became the coordinators. I mean, they have their hold in their own geographies, right? So Standard Chartered Bank was a coordinator for Europe. MUFG Bank was a coordinator for Japanese banks. ICBC Bank was a coordinator specifically for Chinese banks. Now, when a mandate is awarded to these coordinators, it is not specified that you offer this specific geography. Although in this particular case, FAB, Mashreq, MUFG, and Standard Chartered were appointed general coordinators and global coordinators, but ICBC was appointed as the geography-specific coordinator. So the purpose was general corporate purposes. Africa Finance Corporation, as most of you must be aware, it lends across geographies in Africa. Its mandate is basically to fund impact investment and project investment across Africa. So they have no specific purpose there. Their purpose is on lending, basically. And so it's mainly a treasury activity. So the purpose is specified as a general corporate purpose. Now, which are the main banks that have participated? ADCB and ENBD are the main banks that have participated from the GCC space. Mizuho and SMBC were the main Japanese banks that have come in. SocGen came in from Europe. Bank of China came in from China. So there are a lot of other banks that are there, but it's not in public domain. So I'm only privy to this information that I can disclose openly here. Now, this was a senior unsecured term loan for 3 years. Now, the mandate awarded was only for 1 billion. The coordinator said, if we mobilize more, to what extent can you take? So the mandate awarded was 1 billion, increasable up to 1.2 billion. Finally, the mobilization that happened came up to 1.16 billion. So Africa Finance Corporation could access 1.16 billion. This is there on their website. You can actually take a look at the press release for their website, where this deal has been one of the largest syndication deals for Africa Finance Corporation in its history. Previously, all the syndication deals that they've done at about 500 million to 600 million. They initially started out at 100 million. Now, as the trust and the credibility of the institution's name increased across the world, people started investing in participation. As you can see, for a 1 billion, they could mobilize more than 1.16 billion. And the pricing also initially they were looking at anywhere at the margins of approximately 160, 170, in spite of being A-rated. But because of that, the perception of African risk, but today they could raise this fund at about 140 bips over the benchmark. Then we come to a club deal. Now, this club deal I've chosen specifically because I ran this deal personally. This was a geography-specific club deal that I ran for Afri-Exim Bank. Now, this club deal, geography-specific, this was targeted purely towards Indian lenders, and I've taken the liberty to actually disclose as well what this deal was. Now, the mandate that we got was for 250 million and increasable up to 300 million. we could mobilize 282 million. This was a club deal launched as a launched on a best efforts basis. Bank of Africa was the coordinator. Purpose, again, general corporate purpose. This is a senior unsecured term loan with a bullet repayment of 3 years. So we could mobilize funds specifically from State Bank of India, Canara Bank, Union Bank of India, these three Dubai branches, and 2 other lenders from Singapore and 1 other lender from Mauritius. So this was a club deal that we did for Afri-Exim Bank, which was hugely successful. There have been club deals before to Japanese lenders and to Chinese lenders, but this is the first club deal that has been executed specifically aimed at Indian lenders. Now, although this is a club deal on the primary side, the documentation is all general syndication documentation. So nothing prevents State Bank of India or Canara Bank or Union Bank of India to actually trade this particular asset in the secondary market. Now, across all these 3 deals, all the documents are English law documents with specific legal opinions coming in from their respective geographies. Now, for example, Afri-Exim Bank, the second legal opinion came from Egypt. For Africa Finance Corporation, the second legal opinion came from Nigeria. For the government of Tanzania deal that happened for the SGR project, the second legal opinion came from Tanzania. So Baker McKenzie was the legal counsel for the government of Tanzania deal. Now, Baker McKenzie was the English law legal counsel, but we also had Denton's and Eastern Law Chambers who had come in and given in their opinion on enforceability and capability from the Tanzanian jurisdiction. So these are 3 types of deals that have been executed recently and very specific to, very close to where we are in Tanzania and Africa. So what are the key takeaways that we have and important factors that we have? Basically, a deal success for the success of the deal, it's basically the confidentiality and prevention of front running is a key factor, because the syndication, the most important aspect of the syndication process is the pre-sounding and the launch aspect. At that point of time, you wouldn't want any other competitor coming in and jeopardizing the efforts of the arranger himself. Then all these participants, whether it is a facility agent, whether it is an arranger, it's the arranger's duty to give honest and correct feedback to the borrower. It is the borrower's duty to give all the relevant required documents to the arranger. It is the book runner's duty to market it effectively on a sincere basis, so that there are on a best efforts basis, so that they can mobilize funds at the cheapest possible rate for the borrower. And all this is all hinging upon effective communication and closing mechanics and drawing processes as they are executed by the defined roles of each of the participants in this process. The other main important factor is obviously the credibility of the borrower. Now, credibility of the borrower, as I said, it can either come through credit rating, which is done by the likes of ICRA over here. Sometimes lending institutions are very specific about where their funds are being utilized. Some of them may even specify that we do not want our funds to be utilized on fossil fuels. Some of them say what are the specific ESG credentials that this deal is going to bring forth. So ESG credentials and your own credit of the borrower is a major factor in the success of a deal. And one of the other ways for the deals to be successful is you come into the market, do a price discovery, execute the deal well, maintain your commitment to the interest and installment repayment timelines. And once you earn that credibility in the market, this is a small market, there is a word of mouth spreading. They know that you are a sincere borrower. They know that you are a credible borrower. And that's how you can drive down your pricing and you can enhance your treasury efficiencies, which can again get passed on to your own borrowers, whether it's a corporate to its customers, if it's an FI to its own borrowers, which it can pass on. If you raise cheaper funding, you can pass on cheaper credit. And that's the reason why this particular market is so important in driving treasury efficiencies towards overall progress of the economy. I can take question and answer. Zisha, next slide, yes, please. I can take question and answers now. And this is my profile. I'm basically from Bank of Africa, which is part of BMC Group. We are the second largest bank in Morocco. but we also are the second largest Pan-African bank. In fact, even in Tanzania, we have a subsidiary called Bank of Africa. We operate on a subsidiary model where we operate in 20 different countries in Africa. Overall, we have presence in 32 countries. So we are leveraging this to mobilize deals for Africa. I personally sit in the Dubai branch. My mandate is to basically connect Asian and Chinese and Saudi and the Middle East lenders to Africa, bring in more funds there. With our own ground presence and expertise in Africa, it is our mandate to bring in more funds. And the club deal that we executed from India was one such deal where out of the 6 participants who have come in, 5 participants were first-time investors in Africa. So one of the mandates that I have personally is to assess and convey to other borrowers that Africa needs funds and it's a return worth the risk, and the risk can also be mitigated well. So we need to explain the risk well to other funders in the market, and loan syndication is one of the ways to do it. This QR code that I've put is a link to my LinkedIn profile. I'll be very happy to be added and followed. I'm very happy also to take questions now as well as questions later through LinkedIn. You can message me anytime you want, and you can contact me anytime you want. Thank you.
Thank you so much, Mr. Aditya, for this great presentation and giving a brief on the loan and syndicated market. I'm sure our attendees, the people who are listening, they will get benefit from this one, and they have a clear idea, and definitely it will give them a comfort that still there are so much we can do for Africa. We can spread our wings, and we can easily go into the market for the syndicated loans, where they think that the borrower has the credibility, they have the comfort, and they can arrange funding for their relationships, either for their FIs or either for their corporates.
So yeah, Zishan. So while we've discussed international syndications, TIOB can also take a lead here. Mr. Patrick can also take a lead here and actually develop a local syndications market for Tanzania. I have seen a comment from Bahati Thomas who says that we are learning how more lenders can join the capital to finance giant borrowers. They say that let ACB, BOA, and NMB join hands to finance the SGR project. Yes, that is the idea. Local lenders, if they're not able to finance giant projects over here, they can syndicate it themselves. A local syndication market can be developed under Tanzanian law through the Central Bank of Tanzania and TIOB. That can be done. And I do see one or two, a couple of questions here. I'll answer that before we open it up. Thanks for the Anash Shirima says, thanks for the great topic. How is the fee commission being paid? What is the time frame after transaction has been executed? So this is mandated in the fee letter. Sometimes the time frame is within 3 months or within 15 days, but 99% of the time, once the arranger has already arranged and the money has already accrued to the borrower, he would want his fee immediately. So it's on the same day as when the facility agreement is executed. Disbursement can happen afterwards, but the fees, arrangers and the book runners will take their fees upfront. There's no doubt about that. Then Alexander Myra is asking, how can loan syndicates be tapped into by private sectors? So private sectors, I'm assuming, Alexander, you're talking about corporates. So the corporate must already have a bilateral facility with a lender already, right? So your credibility must be known very well to your lender. Your lender, your bilateral lender who you have a relationship with over the years will be one of the best ambassadors of your creditworthiness. So you can ask him, that lender, to arrange for higher credit growth. You can ask him to be the book runner and syndicate it within other lenders, within his colleagues, and tell him. See, sometimes what happens is if you're only doing a 10 million or a 20 million deal or a small deal, the lender, if it's within his capability, he would not want it to go to other colleagues, because if you're a good credit paper, then he would want to keep it confidential. So this will only work if you know that your existing lender will not be able to fulfill your obligations. Otherwise, he will never take your name to the other lender and share the credit. So the only way that can be done is when the relationship between you two is at a mature stage where you can ask your existing lender to syndicate it for you. Vipul Jalal is asking, what will be the fees of arrangers? I can't give you a number, but typically it's some basis points. It's between the borrower and the lender to decide. To give you an idea, it forms a very not a significant part, but a very small part of the overall cost to the borrower. Imran says, why is the borrower kept confidential at the initial stage of the process? Okay, unless the mandate is signed, the arranger cannot tell his name outside. It is because of two purposes. One is confidentiality basis, because, for example, say Africa Finance Corporation is looking to raise funds, and at the same time, say, for example, Afri-Exim Bank also wants to raise funds. Now, the market appetite for Africa is limited, right? So if Africa Finance Corporation is raising funds and that gets known to Afri-Exim Bank, it's possible that they go to the market first, and then Africa Finance Corporations will have to plans have to be delayed. That is one reason. The other reason is, if I'm trying for a mandate from Government of Tanzania or Africa Finance Corporation, and if I reveal in the market that this is the borrower that I'm tapping into, it's possible that my competitor bank goes to that particular borrower and says that I can mobilize funds at a better rate for you. It's called front running. So that might happen. That's the reason why we keep it confidential. What can be the minimum loan amount? Well, if it's a very small loan amount, I mean, the cost of syndication is too much, right? I mean, you have the legal processes. The process is also long drawn. So if it's not, if it's only a good, there's no specific limit on what is the minimum loan amount, but it should make commercial sense for us to actually go on and accrue all, for the borrower to actually incur all these legal costs and all the process costs that happen. Geoffrey says, how can startup companies tap into this opportunity? Example, financial institutions. Geoffrey, are you specifically referring to a financial institution which is a startup? The first process would be, I would say, you can approach Zishan or Mr. Patrick for advisory and get yourself rated. So once you are rated, it's possible that lenders would be happy to look into your loan. So what is the legislation governing loan syndicate market in Tanzania? So that would be the regulations and the legal framework of the contractual legal framework in Tanzania. But nothing prevents any corporate to do it under English law if they are looking for international borrowers. So within Tanzania, I would I think Patrick would be more. It'll be better for his input to take on what is the legislation governing loan syndicate market in Tanzania. Robert says, how does lender share risk for the syndication loan? Now, after you've taken on the syndication loan, it's within your mandate. You're free to go and get it reinsured or insured. You can cover your risk by that way. The other way to do it, sell it in secondary market on either a disclosed basis or an undisclosed basis. Now, for example, Bank of Africa has taken the risk of Government of Tanzania. If I would want to be the lender on record by the time deal ends, why I do that is because when the deal is financed, I would want Government of Tanzania to know that I have been your lender. So I would want to remain on record. So at that time, what I would do is I would execute a risk participation agreement with another bank and say that this is the risk, but you will not be the lender on record. Or if I can actually sell my portion, wherein the asset actually gets transferred to the other lender. Say Bank of Africa sells it to Bank of Africa sells it to say, for example, Atijari Wafa Bank, and Atijari Wafa Bank comes on record as the lender on record. So that is how risk sharing can be done. Either you can get it insured yourself, or you can have a risk sharing agreement executed on a non-disclosed basis, or you can actually sell down. So that's how risk can be shared, Robert. Patrick, if you would want to weigh in on Alexander Myra's question on what is the legislation governing loan syndicate market in Tanzania?
Thank you very much, Aditya. I think there's a component here for Ikra to come in terms of loan syndication from a local market context. But in actual sense, you know, there are a number of loans to look at, laws to look at when you're looking at loan syndication locally. Part of it is the legal framework in Tanzania being modeled off, you know, English common law. So contract law and the principles of it still apply. There's the Companies Act that guides as well in terms of what does the constitution of the borrower indicate? Are they able to borrow, first of all? You know, does it allow them the memorandum and articles of association? In terms of the laws governing a corporate ability to borrow, basically guided by the central bank regulations in terms of raising financing. What are the conditions? Does it have to be registered with the central bank? The license of the financial institution trying to arrange that, you know, the lenders. What are the limitations of the license? Remember that there's different grades in terms of financial institutions licensing in Tanzania. There's for commercial banks, there's for lending, so there's for DFIs. So all of these have limitations in terms of the limits, the capital requirements in terms of hedging, making sure that you've covered yourself as a risk entity. So there's minimum capital requirements when you're getting a license from the Bank of Tanzania as well. And then there's also, you know, laws governing transactions, cross-border and local as well. So those have to be observed as well. If you're raising funding from outside, what are the conditions under which that transaction can come into Tanzania? If you're a lender locally trying to participate in a loan syndication market internationally, then what are the laws that are limiting you? What are the registration points? What are the documentation that you need to file with the regulator as well? So there are all those components that are working together at any point in time when you're arranging a loan syndication, and hence legal advisory is very much important when you're doing a loan syndicated arrangement locally. You need to have a legal advisor appointed on board as part of the transaction. That including an information memorandum as well, very much important. Yeah, so that just a few points there. So the other parts is where the credit rating agency comes in with all the, you know, the relevant opinions on valuation and you know, assessment and so forth. Yeah, I hope I've in some way responded to that question.
Thanks, Patrick.
Yes, you covered it very well.
Yeah, one question from Peter Zishan. Yeah.
Yes.
Peter Madaha says, as the borrower can initially receive whatever amount already mobilized and inject into the project, how sure is the remaining amount be fully mobilized? Peter, financial closure is one of the most important conditions precedent for a loan to be disbursed under a project loan, unless it is very specifically mezzanine loan or a part funding or pre-project funding. Typically, financial closure is one of the conditions precedent. Now, what we are saying over here is, once we mobilize, say, for example, there is a project cost of 500 million, out of which the equity component is 100 million. And the borrower opts to go for a best effort syndication for 400 million. In any case that the 400 million is not reached, and we are only, say, at 350, before the 350 million is disbursed by all the lenders, that 50 million gap has to be fulfilled either through equity participation or through another bilateral loan executed. Financial closure will become one of the conditions for a project. So at any point of time, it is not going to happen that the lenders have come in with their commitments and that is simply drawn without the financial closure happening. So it's there, under a project, it's always that condition is always there. No one does that. So I hope that answers your question. And Louis, you do say that in your opinion, it requires more time for one to understand well the documentation in particular. Yes. So Loans Management Association has published 18 different documents for each different kind of loans. Now we can have term loans, we can have revolving credit facilities, we have general corporate facilities, we have non-senior debt, we have mezzanine loans, we have ECA backed project loans, we have secured loans, we have unsecured loans. So we have different types of loans, right? I mean, although the basic products are either for working capital or for term loans, we have different types of loans. So each of these loans have different types of documentations. All the mandates are not plain vanilla. Obviously, whatever I've discussed over here are all plain vanilla loans borrowed by either a sovereign or an FI. When a corporate borrows for a specific project, there are a lot other components that are there. If it's an ESG loan, sometimes the pricing is linked to the ESG. Sometimes the pricing is also linked to a rating. Now, I'll give you an example. One of the loan that we did was for Investec Bank in South Africa. In my previous role, I was a part of the book running team for Investec along with Standard Chartered. So at that point of time, what had happened was we arranged it to be a sustainability linked loan. The pricing that we had, say for example, is 140 bips rated at double P. But what we also specified over there is that if the rating goes down by one notch, then the pricing will increase by 5 bips. Similarly, if they do not achieve the specified ESG component, then the pricing will increase by another 5 bips. So we can also have the pricing ratchet linked to performance parameters. So that is one other way. That is this all comes into the documentation. So when the terms are decided, it's very complex. So for you to understand all the documentation that goes in, each facility agreement is about 80 pages to 70 to 80 pages or 40 to 50 pages minimum if it's a plain vanilla loan. Then there are multiple tranches that might happen into a loan. Like it can be multi-currency loans as well. It can be Tanzania local currency linked with dollar currency. Then there are hedging covenants that come in. That's also a possibility. Then people can also borrow USD term loan, local currency working capital, local currency term loan, and USD working capital. So you can have 4 tranches as well. Like one of the loans that we did for Harmony Gold Mining in my previous role was a 4 tranche loan, wherein I had committed for about 100 million, but it was a 4 tranche loan. So the arranger had specified that it has to mandatorily be proportionate. Sometimes the arrangers say it's not proportionate. You are free to participate in any particular tranche. So again, the documentation will vary according to that. So yeah, it's very complex. Yes.
Great. Thank you, Mr. Aditya. Thank you so much for satisfying the questions. At the last, because we have just a few minutes left, I will request my director, Mr. Hassan Mansoor, to come up to show himself and give the closing remarks to our wonderful audience.
Thank you so much, Zishan. I think I'm audible. Can you hear me, everyone? Yeah, thank you, Aditya, for that wonderful presentation. I think also I've learned more on the syndication part, more terms, and it has added value to all of us. Thank you also, Patrick, for hosting us. And as our member, I'm very proud also to be part of this webinar. Apart from that, it's just to have a very, very, very thank you to Aditya, and we wish to have more webinars with you to discuss more on the syndication part, but also how does credit rating assist syndication? As you have said that it provides more value, so speed up the process of syndication. So we thank you so much, and we believe that there are a lot of webinars to come, and to be proud also we partner with you. Apart from that, I'd like just to thank the whole members who attended to this webinar, and we promise that we'll also provide more webinars between us and TAOB, especially on the correspondence side or trade advisory. Not only that, but also on credit lines also. So more webinars are to come, and really, just to provide very thank you. And as a credit rating agency, we are locally based here in Samora Tower in Dar es Salaam. So we invite each and everyone just to come and understand more on the credit rating. So please, thank you, and thank you so much, Zishan. Back to you.
Thank you, Mr. Hassan. Thank you so much. Thank you, Aditya. Mr. Patrick, last words from your side, and Mr. Aditya. I will go first with Aditya and then Mr. Patrick, and we'll close our webinar.
Oh, thanks for the opportunity. It's absolute fun going on to the academic side for some time, forgetting your business responsibilities that are there. Thanks, Patrick, for the opportunity for a great introduction. You actually started off well, because that's the main reason why we were looking to understand this topic, basically to better our own lives through bettering the economy. And thanks, Hassan, for that vote of thanks. Thanks so much. Thanks, Zishan, and all the management from ICRA for partnering with TIOB. You guys are actually doing a great job, because we have bankers participating over here. We have corporates participating over here, and hopefully this has helped them and added value to the time that they've so thankfully spent with us. Thanks so much.
Thank you, Aditya.
Thank you, Zishan. I really appreciate the opportunity to contribute to Mr. Hassan's closing remarks. For me, just to add on what I said earlier on at the start of this session, for this market, visibility and exposure both ways helps to understand the syndicated loan market. And I think as we're trying to look for new avenues to bring in financial solutions to those who need, to finance projects and programs, I think this collaborative shared knowledge approach is one that will help to realize the opportunities that are often missed. And I think all different partners have a role to play in the value chain that brings the solution to the customer. The credit rating agency has a significant role to play. The lender has a significant role to play. The borrower, in their own capacity, has to be well structured, well documented, and has to understand themselves very well in order to be a recognizable and an understandable borrower in the syndicated loan market, to be given the sufficient profile to be able to be given the proper terms, the best terms for themselves. So I think we have a journey, and I think this is, I feel very, very encouraged that as something that was very much a small component of this market, about 30 years back, there was only one single loan syndicated arrangement in Tanzania in 5 years. And that was it. There was nothing else. Now, recently, you're starting to hear the standard gauge rail is now, in a syndicated loan arrangement. Pretty soon, you'll have a club deal going on. And I think this market is opening up because there are individuals who understand this type of financing solution. And I think the more people understand, the better. So TIOB is about democratizing the knowledge, and then partners make this possible. And I thank you all for being our partners. Aditya, you are as much our partner today as you will always be going forward. We are grateful that TIOB has had this visibility with you as well. And we are grateful for ICRA's partnership and their willingness to continue to work with us as we, build a body of knowledge that can be shared by, with all the players in this market. Thank you.
Great. Thank you so much, everyone, for joining us. There are many more to come. Please follow ICRA on LinkedIn, on different social platforms. There are many more to come, as Hassan said, and we will keep you updated. Thank you so much, everyone. Have a wonderful day ahead and stay in touch. We will come back with a new topic again, inshallah.
Bye, everyone.
Good. Thank you.
Bye-bye.
Thank you, Patrick.
And bye-bye.
Thank you, Zishan.
Thank you, Aditya.